Hi, and thanks for tuning into Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with John Kim, Panagram CEO and Co-Portfolio Manager for CLOZ and CLOX, two ETFs which we're going to talk about today. John, thanks for joining me.
Thanks, Sumit. It's great to be here.
Awesome. So, John, I'd love it if we could start at the top and have you tell us what CLOs are.
Yeah, well, CLOs are actually a very simple product. They are based on corporate loans. So think of a pool of corporate loans that you would put together in a package, and then you can issue securities against that. Now, the number one thing to understand about CLOs is they are not CDOs. We get this question a lot. People confuse them with the structured credit instruments that blew up during the crisis in 2009, 2010. These are not that. Similar name, but very, very different product. CDOs were based on mortgages. These are based on corporate loans. And corporate loans performed really great throughout the crisis and in the years before and since. So for the most part, we are really happy that we're in CLOs. It's been a great career to be in this product because the product has been so stable and has grown so significantly over the course of the last 20 years or so.
And are these essentially bank loans that have been securitized?
There are bank loans that have been securitized, and the market for bank loans has gotten really quite large. It's over $1.5 trillion now outstanding. With the advent of private credit and other types of credit instruments coming into the market, the lines between bank loans and other types of corporate lending have been blurred a little bit. However, in general, corporate loans have been a very great credit asset over the long period of time because they're both senior and secured by assets of the company, senior in priority of payment. Those two qualities of corporate loans in general have really saved a lot of investors from suffering the true effects of having a company go sideways because if a company experiences some issues, they still have to pay their loan interest, right? They don't want to lose control over their company. And so a senior secured loan is really one of the best ways for investors to access corporate lending. And it's very, very different from investing in high yield bonds, which are subordinated and generally have no collateral attached to them at all. So senior secured lending is a great asset class, and that makes it a great securitization product.
That's great. So if I'm not mistaken, John, you have two CLO ETFs, CLOX and CLOZ. Can you tell us the difference between the two and what are the different risk reward characteristics of this pair of ETFs?
Sure. We launched CLOZ in January of 2023. CLOZ concentrates on BBB and BB rated CLO bonds. BBB is investment grade, BB the notch below, sub-investment grade. These are very safe bonds. However, they are fairly yieldy. So I think the current SEC yield on CLOZ is about 10%. We think of it as a spot where you need to do some credit analysis and you need to do some picking of CLO managers to make sure that you are getting a good, diverse, and solid portfolio with enough liquidity to satisfy ETF demands. CLOX, on the other hand, only buys AAA CLO bonds. AAA CLO bonds are the top of the capital structure, first in priority. There has never been a CLO AAA default in the entire history of the CLO market, so 30 plus years. They are extremely safe bonds, and many people who understand the structure of these deals and have participated in this market for a long period of time view them as safe as treasuries. Treasuries might even be AA at some point, right? We don't know. But these are really AAA rated. They've not even come close to an impairment over a very long period of time. So we think of CLOX as super safe, super senior. CLOZ, if you're willing to play in that sort of lower investment grade, top of the non-investment grade capital stack, you're going to get rewarded for that with a lot of excess yield.
Now, John, a lot of people are looking at the bond market today and things are pretty uncertain, right? Everyone's wondering when's the first Fed rate cut? How many rate cuts are we going to get? And also, what's the economy going to do? Are we going to fall into a recession or is growth going to be strong? It's a really uncertain environment. So I'm curious, how are CLOs impacted by interest rates and the economy?
Yeah. So remember that CLO bonds are floating rate. So there's a benchmark, which is based on where rates are, and then there's a credit spread added to that. As we all know, for the last 20 years, it's been a fool's errand to try to predict rates and where they're going to go. I think people were surprised that rates stayed low for so long, and then they were very surprised when rates rose. In a rising rate environment, you get more yield in a CLO bond. And so we've been able to ride that up, and you don't get a deterioration in price the way you would with a fixed rate bond. Just the math is different. But conversely, when rates start to fall, you will get a lower yield that you got before. But absolute yield is not what you should be thinking about when you buy a CLO bond. You should be thinking about the credit spread, right? So how much extra premium am I getting over wherever the rates are going to give me? In triple Bs, that's generally about 400 basis points, long-term historic. For double Bs, that's about 700 basis points. So it's really quite a yieldy credit spread. So even if rates go down, like if rates were at zero today, you'd be very happy with a 5 or 6% yield, right? And that's sort of what CLOs are going to deliver. In any credit environment where rates go up or down, you're going to be able to either capture excess yield due to rates, or you're going to have a good credit spread to mitigate the fall in rates. In terms of the economy, look, leverage loans are a big bellwether because some of the companies that are most active in the loan market are smaller companies that often are really the backbone of the U.S. economy, right? These are growing companies in very, very diverse industries, lots of different sources of cash flows. Now, it is true that, and everyone's been talking about corporate defaults going up. We haven't seen a big spike yet. It has been trending upwards. As companies deal with higher interest rates, they're going to have to make changes, cut costs, do some of the things that they're supposed to be doing to make sure that they can service interest debt. But if you're the buyer of a CLO bond, remember that you are not taking a first loss. Think of it as a pool of 100 loans. And if you buy a double B, 8 or 9 of those loans have to go to zero for you to get hurt. For a triple B, 12 to 14 loans have to go to zero for you to get hurt. You're still quite protected given the overall diversity of the pool from loss, as long as the overall lending environment remains sane and you still have collateral to get recoveries on these loans. So look, we're very concerned about the economy. Everyone is. We keep a really close eye on performance of the companies in our underlying portfolios. But at the same time, as a buyer of CLO bonds, you have a level of protection that I think you don't get, if you're a pure high yield investor or if you're investing in single names, right? So, for example, if you bought a loan index BKLN ETF, you're exposed to any individual loss in that pool, right? If something goes wrong in the BKLN index, you're going to suffer that loss in the NAV. As an ETF investor there. But if you invest in CLO bonds, you are protected from that single name loss.
So these are certainly some interesting products, John. How should investors use these in their portfolio? Let's say they have AG or something like LQD for corporate exposure. How do these two CLO ETFs fit in that?
Look, I would say that for any investor who's trying to create a diversified portfolio, we think that CLOs should be a permanent part, not just a part-time or sort of limited. Let me try to go in when it's cheap and get out when it's expensive kind of thing. We think that CLO mezz should be a permanent replacement for at least part of your high yield exposure. If you're going to have high yield exposure and you're going to take that kind of risk, CLO mezz is a great proxy for that. It's floating, which is different from your typical high yield exposure, but at the same time, it's giving you a very yieldy premium. And you're not taking a lot more risk, anywhere in that structure. Not nearly as much, in our opinion, as you would be taking in a high yield bond fund. For CLOX, which is AAA, we think that's a great replacement for cash. It is super secure. It is super senior. You're still getting a great credit spread. Right now, our ETF is yielding about 6.6, as you see. So that's a great yield for holding cash. That's a pickup of, I don't know, about 200 basis points maybe to a money market or typical, sort of short-term bond fund, ultra-short bond fund. So we think that again, that's a great cash substitute, but you're still picking up a little bit of excess premium for leaving it there. Highly liquid, very tradable. So we think that those two ends of the spectrum, if you will, both have places in an investor's portfolio, sort of, basically as an everyday allocation, as part of an overall diversified portfolio.
John, before I let you go, I want to congratulate you. You're a finalist for the new ETF Issuer of the Year award in this year's ETF.com awards. Can you talk about, what it means to be a finalist?
Yeah, no, it's been great. It's been a labor of love for us. We are not going to be competing size-wise with Vanguard or BlackRock anytime soon. We're not going to have thousands of ETFs. We are credit specialists. We have a niche. We are a very, very precise investor in the sense that we stick to our knitting for things that we know extremely well. So CLOs are one of our bread and butter items. Issuing an ETF based on what we know and love, and and we're in that market every day. That's been a great achievement for us to sort of have it be recognized by ETF.com and others. So we are very, very excited as a team to grow this ETF, and we would be, we love the fact that we were nominated for this award.
Fantastic. Well, we're going to have to leave it there, John. It's been an absolute pleasure having you on the show. Thanks so much for your time.
Thank you, Sumit. Great to meet you.